Hello, everyone. Welcome. Hello, welcome. We're just going to wait for a few more people to come in, and as they come in, we'll get started. Wonderful. Welcome, everyone. Thank you so much for coming. Welcome. Cool. So welcome. I think we're almost ready to get started. I might give it just one more minute just to make sure everyone has a chance to join who wanted to join and who's registered. But just in 1 second, we'll get started. As you may know, we're live on Facebook as well. So we're going to see if anyone wants to join from Facebook as well as here on Zoom. Okay. Well, thank you all for coming. My name is Sinopsis. I'm a project assistant in the Economic and Financial Threats program here at PSSI, and I'm very excited to be able to moderate this discussion. We have truly distinguished guests and some amazing panelists. But before we get started, I just wanted to go over a few technical issues. This panel, we have 3 speakers. Each speaker will be given a chance to provide their perspectives, and then at the end, we will have a Q&A session where you'll be able to address all 3 panelists. If you would like to ask questions to the panelists, there will be a Q&A function in Zoom, so you can add your questions there. Or if you're joining through Facebook, you can also drop your comments in the comment section in Facebook. Now, as you may already know, the capital markets have been a huge source of funding for Chinese bad actors. This has been an oversight for far too long. Luckily, we are joined today by Roger W. Robertson, Jr., chairman and co-founder of PSSI. He is also the person who originally brought this issue to light. Roger is a former international banker with Chase Manhattan Bank. He served as Senior Director of International Economic Affairs at the Reagan National Security Council. He served as Chairman of Congressional U.S. Economic and Security Review Commission, and so much more. I don't think he could have more titles that I could add, but I would probably run out of time. But he is a very, very accomplished, and we are so happy to have him speaking today. Our second panelist is Jan Lipavský. He is a member of the Czech Parliament and Committee of Defense and Foreign Affairs, and we are very happy to have his expertise on defense and security. Our third speaker will be Martin Hála, who is the director of Sinopsis, and we cannot be more of his perspective on China. So I think that's all of the boring stuff out of the way and all the technical details done. So without further ado, I will hand the floor over to Roger.
Well, thank you very much, Simone, and welcome to the audience. And thank you so much for taking the time to look in on this today. I couldn't be more pleased to have my 2 associates and good friends here to talk to this issue as well. So leave it to say that in the way of background, the capital markets are not an intuitively obvious topic to a lot of people, and they might not see how it could possibly fit into the matrix of national security and human rights policy. But I would argue it very much does. And indeed, it represents a kind of dimension, a large dimension of 21st century national security, where matters are more subtle, shall we say, and the economic and financial domain is turned into, frankly, a warfighting domain at some level. Certainly, it's a strategic domain. And China and Russia both use it very actively on a daily basis. So I would just say briefly that I entered this picture in the late 1990s with an awareness of some of the wrong types of Chinese companies entering the US capital markets. In that particular time frame, it was PLA, People's Liberation Army affiliated companies that were the concern. That were in the portfolios of the California Public Employees Retirement System, which is one of the 2 or so largest public pension systems in the United States. and testified before the legislature of that state about this problem way back, as it were. More recently, starting in about 2016, we started to do more intensive research on the subject and did a report for the American government that was quite extensive. But in March of 2019, we went public with a number of those findings, research findings, for the first time. And a lot has happened since. But the long and short of the story is that for over 2 decades, the United States never was engaged in screening, monitoring, or otherwise performing diligence on Chinese companies entering the US capital markets. It just wasn't done. You know that that's not true in the trade sector. We have the Committee on Foreign Investment in the United States. We have EU screening mechanisms on mergers and acquisitions today. There is an effort on technology security in particular that is increasingly monitored, and there are constraints on what the Chinese can buy in terms of our companies and technologies and the like today. That never existed in the capital markets, and as a consequence, a whole range of what we might call corporate bad actors entered our markets. Now, what do I mean specifically there? Well, I'm talking about companies that, again, are affiliated with the People's Liberation Army and the Chinese military. They are advanced weapons manufacturers. They are the companies that are building and militarizing the islands in the South China Sea. They're weapons proliferators to North Korea, Iran, and other terrorist sponsoring regimes. They are companies that have enabled and equipped the concentration camps in Xinjiang, who are in the business of aiding and abetting genocide there, as well as forced labor and a number of other egregious human rights violations. So this is beyond a national security concern. It is a very profound human rights issue as well. And these companies have not been penalized at all in terms of their ability to raise large-scale funding from, it turns out, something in the neighborhood of 120, 150 million unwitting American retail investors. And this is not something that is just over the Atlantic. Europe has the same affliction. It just hasn't surfaced as much as an issue here as it has in the United States. So the concern here now is that you have this unwitting financing that's not just in the tens of billions of dollars. We're even past the hundreds of billions. In, say, the last 10 years, it would be, I think, over $1 trillion, and estimates have been as high as 2 or 3 trillion. Now, this includes all forms of involvement in the capital markets, including passive investment vehicles, but that's a subject that we'll get to just in a moment. So we do have a very serious problem here that has only recently been addressed. Going back to 2019 in the summer, we found that, for example, the Federal Thrift Savings Plan, which is the retirement system of 6 million federal government employees, including all of our military personnel, we're going to have in their international investment portfolio the same list of several Chinese corporate bad actors, both national security and human rights violators, that were going to be added to the investment portfolios of the uniformed military and every other federal employee. I hope it's clear as to the irony, the supreme irony and egregious nature of that development, which fortunately didn't happen as the president of the previous administration intervened some 2 weeks before this change was to take place to nullify that possibility, to basically bring it to a screeching halt. The same was true with the federally administered railroad retirement system. We found there were bad actors there. You're talking about, taxpayer supported entities here, and they too had Chinese companies excised from their investment portfolios. So this caught on in a pretty big way in the previous administration. It was followed by the president issuing an executive order in November of 2020 called Executive Order 13959 that basically said that the companies that were appearing on a list provided by the Pentagon by law to the Congress of the United States called the Communist Chinese Military Companies List under the National Defense Authorization Act, that list of companies, which was about 44 at the time, would be subject to capital market sanctions for the first time in American history. And those sanctions would mean that within 1 year's time, no US persons could be holding the stocks and bonds of those listed companies, and that they would be, in effect, forced to divest those companies from their portfolios, as I say, in that decent interval of 1 year. So the question became quite a big one as to how the Biden administration would react to this particular act, whether it was seen as a belated effort that might not be meritorious on the part of the Trump administration, or was a very studied effort, which it was, I'll tell you, and that it was worthy of great concern, and that we don't want the American people in the business, unwittingly, particularly, of financing concentration camps, genocide, or submarine-launched ballistic missiles targeting their families. I think it's a fair bet that that's an untenable political position. I mean, this is not an abstraction. This is actually the money of well over 100 million Americans. And again, the same is true with Europe. So as I say, don't feel that this is so distant from many in our audience today. It's not, as I'll explain. This was the state of play, and it was resolved on June 3rd when President Biden issued his own amended executive order, if you will, 14032. And although there were some structural changes, for example, it was more moved from the Pentagon's administration to the administration of, or the administering, I should say, of the Treasury Department and its Office of Foreign Assets Control. The bottom line is the president preserved the previous key provisions of the earlier administration and actually expanded and strengthened those measures. That came as a big surprise to many on Wall Street, who kind of counted, frankly, on the Biden administration to narrow, dilute, even rescind entirely these Trump-era capital market sanctions. So they were very disappointed, I think, but it's to the benefit of the country, and it's certainly very important from 3 points of view: national security, human rights, and investor protection. And just a quick word about investor protection and what I mean by that, what I call third pillar. You know that not one Chinese company in the American capital markets, and I think there are over 1,000, are compliant with US federal securities laws. Meaning, for example, the law calls for all companies in our markets to be audited by the Public Company Accounting Oversight Board. It's a federally administered program designed to make sure that we lessen the chance of fraud. China won't submit to it, has refused to do it, and indeed, it doesn't even disclose its financials, which are regarded as state secrets. So you have sort of black box companies here that represent a very serious material risk to prospective American and other investors. And that represents the investor protection side of this equation. So leave it to say that there are still kinks in the system, but for the most part, the Biden administration has stepped up to this issue properly and has taken it very seriously indeed, and even added surveillance technology sector companies, a very important addition, because so many of the human rights abuses taking place in China are based on this surveillance state, on cameras everywhere, on facial recognition, on artificial intelligence, all as ways to track down dissenters and incarcerate them in the case of the Uyghurs, or even worse in terms of atrocities. But the Tibetans, other religious minorities, are facing the same kind of fate. So again, the human rights piece of this is critical. And I would just close out this kind of background section, if you will, by suggesting that even today, 5 companies in the polysilicon related business have been identified today as engaging in forced labor activities. And yet 2 of those 5 companies appear on US exchanges. And the problem there, just to give you a live example of the challenge, is that although you can't, if you're an American company, you can't provide equipment, technology, services, or components to those companies anymore once they're placed on the entity list. At the same time, as far as the fundraising activities of those same companies, they can be prospering on the US capital markets with total impunity. Now, there's something terribly wrong with an inconsistency from a policy perspective that's as glaring as that. I think one would agree. So we do have more work to be done here as a nation. Luckily, we have very strong bipartisan support on this on Capitol Hill. I would even say almost unprecedented support, which is very encouraging, because loopholes like this can be adjusted, hopefully by the administration, but certainly the Congress is going to be playing a very active legislative and oversight role, all to the good. So with that, I think I'd like to push on to my good friend Jan Lipavsky, and apologize if I went over my requisite 15 minutes there. And over to you, Jan.
Thank you very much. Thank you very much for inviting me to this debate, to this roundtable. And thank you very much for bringing up this issue and making some noise about that, and creating all those analyses. And I will start with one simple question, basically. Is this very US, very American issue relevant for EU, for European Union, for Europe? And my simple question, it is. Of course, there is many differences between financial system in US and in European Union. The way how citizens in Europe have solved their pensions, it's quite different. Everything relies much more on states, even though we have private funds when you can put your money for investment. However, definitely, this is part of something which reacts to the current state of globalization and political reaction to the mere fact that China is on the rise, and also relationship with Russia. It's on a very wrong path between. So, and we have this huge bundle of issues. You mentioned technologies. It was demonstrated on G5. We had this debate a few years ago it was a really big debate. Could Huawei be part of that of our infrastructure or not? Nowadays, I'm not saying it's solved, but the major part of the debate is over, and Huawei was not included in the key part of internet infrastructure. And now we discuss the future technologies which are forming, which will form the future defense structure. You mentioned AI, big data, machine learning, serverless technologies. And also part of that is a structure of ownership of the global corporations. We have big businesses. The most important business, every important business in Europe has some part of their operations in China, some factories, or at least they want to operate on China market. And on the other side, we witness the screening mechanisms. See fields like in US or European versions in different provisions. Each European country has own way how to screen, some of them not, are definitely part of the whole issue. And to ban malign investor from investing in Europe or in US, and let's be open, those malign investors might be, for example, Chinese corporation looking for know-how or looking for companies owning big data sets, because that has own strategic values on one side, and on the other side has to have a capital market where those companies in some cases are traded and funded because funded by European or American capital. It really doesn't make sense. We also see similar situation in energy sector. One of those listed companies, which is on the bad actor list mentioned there, is the China General Nuclear Power Corporation. We procure new nuclear power plant here in Czech Republic. For some time, the government was all the time speaking about the fact that even the Russia and China side might be or should be included into this process. Now that's all, this part of debate is also over. And then we have a wide range of academic cooperation. So for me, this issue of trading, companies, funding and trading, because that's interconnected, it's one of the future topics. Definitely not massive as in US, but something which should be solved on from my side on EU level. It should be raised on the level of national states where these businesses operate. So Frankfurt Stock Exchange, clearly that we are speaking about Germany and their law for regulation of stock exchanges, and that's something. I don't know what the solution is, honestly. I don't know what the solution is, but I feel that the direction is absolutely clear. If NATO and Europe says that China is a systemic rival, then also this has to be approached on the level of financial markets.
Mm-hmm. Over to you, Simone.
Wonderful. Thank you so much both for your comments. I'm going to now hand the floor over to Martin Hála, who is joining us also remotely. So Martin, the floor is yours.
Well, thank you. Thank you very much. Thanks for having me on this panel. I have been following Rogers and PSSI's work on China's utilization of the US and other democratic countries' capital markets with much interest, and I would say fascination for some time now. It is indeed a huge irony that the country that the United States now labels as a strategic rival has at the same time been the beneficiary of funding coming from the American capital markets. That in effect, America has been actually funding its quote unquote rival, including this rival's military industrial complex, and also, as Roger has mentioned, the growing surveillance industry. So this pumping of money into the Chinese military complex is perhaps the most striking example of the abuse of the Western capital markets. But there are many other curious uses for Western investors' funds, or in some cases just pensioners' savings, as we have seen. I have read quite recently an interesting report on some European index funds' contribution to the Chinese coal industry, where European investors, and again in this case European, I think it was specifically Dutch pensioners, were actually funding Chinese coal companies, coal industry companies building coal-powered plants, which have been exporting these polluting industries back to Europe alongside the Belt and Road, and in particular to some parts of Europe, like the Balkans. Now, in the Czech Republic, the financial markets are admittedly of limited relevance, but even here we have seen some rather peculiar financial behavior from rather curious Chinese companies. Particularly striking was the case of a now notorious Chinese company called CEFC that for a couple of years dominated the Czech-China relationship, and was at the time hailed as the flagship of Chinese investment in the Czech Republic. The chairman of the company even became one of the advisors to the Czech president. The company went on a highly publicized shopping spree in the Czech Republic, making all sorts of acquisitions, before it turned out that the whole company is actually just a huge financial fraud. And not only that, that the company has been engaged in political corruption in different corners of the world. And in the end, one of the representatives of the company was actually convicted at a federal court in the United States of bribing civil and political leaders in Africa, and also top-level officials at the United Nations. So, this particular company, CFC, didn't raise capital on the capital markets. It went around it and borrowed directly from some local banks. But nevertheless, it was a striking example of some of the peculiar financial behavior of Chinese companies that we have seen here in much detail, sort of close range. So I think I'll limit my introductory remarks to this, and I'll wait for questions from the audience. Thank you.
Wonderful. Thank you so much. That was super interesting and definitely something that I didn't know. So now we're going to move on to questions from the audience. So as I said at the beginning, feel free to drop your questions into the Q&A here on Zoom, or if you're joining us through Facebook Live, you can leave your comments in Facebook and we'll try to get to as many as we can. So we first have a question specifically for Roger. Asking, are there special provisions in the United States to account for the possibility of Chinese CBA operating in American financial markets through fiscal havens, shell companies, or similar mechanisms?
I don't know of any prohibitions. For example, most of the Chinese companies with a presence in the US markets are registered in the Cayman Islands. and they set up elaborate vehicles, investment vehicles to do that. Alibaba is a famous example, where you own a piece of a holding company, but not the stock itself. I mean, in other words, it's a bit arcane and complex, but leave it to say that there's a lot of financial engineering going on here that is less than transparent and is problematic in my view. After all, when you're dealing with an obvious potential adversary, like you are in the case of China, that combines their commercial activities and their military strategic seamlessly by design, you run into disclosure and transparency problems that are special to the country. And it requires, for the purposes of prudence, particularly fiduciary prudence, to see a very clear path of where American people's money is going and how it's being used. One can't just leave this to pretend as though Chinese enterprises, which are controlled by ultimately the Chinese Communist Party, are somehow the equivalents of known European companies or Japanese or South Korean for that matter. We can't pretend as though this is the case. So these jurisdictional issues are of concern. And I would say that the same kind of thing afflicts Europe. I would just quickly say that we did a study on the Frankfurt Stock Exchange to see what kind of exposure they might have to some of these Chinese national security and human rights bad actors, most of them or a number of them sanctioned by the United States, and found that there were 68 such companies traded in Frankfurt, many of them through indexes, admittedly passive investment vehicles, which is where most of the abuse frankly takes place. In the United States, those are run by companies like BlackRock and Vanguard in so-called exchange traded funds, which is just another way to say an index fund that you invest in. So we wanted to better understand, as Jan Lipavsky mentioned, how big a problem is this in Europe? I mean, is this an American thing or is this an allied thing? And the answer, not surprisingly, is it's very much an allied thing. We're hoping to look at the Milan Stock Exchange as our next exercise from an analytical perspective. But leave it to say that the time will come where regulators in the EU and in individual countries like Germany, not to mention the board of the Frankfurt Stock Exchange and executives that are looking after these matters, need to be alert to the fact that this has taken on real proportion in the United States. I mean, this is not some sidebar issue anymore. It's going to join trade and technology security in the big three of the pantheon of US-China economic and financial issues. And I think the same is going to be true here in Europe. It just hasn't manifested itself fully as yet. So in a way, the purpose of this roundtable is to probe this issue and see if we might build an educational foundation that allows folks to better understand the game. It is a common sense thing. You don't need to have a PhD in finance, and you don't need to be a former Wall Street executive or part of the London city to get it. And that's what really we're all about today. Thanks.
Wonderful. Thank you, Roger, so much for your answer. I have a question now here from actually one of my former colleagues at Tundra. He's asking, considering the heavy weight that China is in many major economical aspects around the world, how can we counter China's economic growth without harming global markets? And I guess this question is open for the whole floor.
Maybe I'll
Yes.
begin. That's a very good question. but I think it has to be stated in the very beginning that China doesn't behave by the international rules, and that for China being part of international markets and organizations like WTO and etc., it's always about to negotiate something special, and China hasn't opened to foreign capital much. Everything is under control. It's created through different kind of structures. The Chinese in many cases has to own the control share of those businesses, and etc. So this is more about West and the developed world being able to keep control, at least some control of global trade, than by doing these kind of steps for the matter of national security, US or European countries to see that this will curb the international space for trade. That would be my answer. So definitely international trade area is not something which would be anarchistic. It has to be designed by rules, and by rules which we are able to control. And I have written down a few points I maybe might have mentioned in my introduction note. So I would like to mention right now. Is it okay? First of all, Europe and US work on Magnitsky laws in different matters. These are norms which name and shame specific people, specific companies. So we also need mechanisms to project this into financial sphere. In Brussels, now basically lies frozen comprehensive agreement on investment between EU and China. And it seems that it will be frozen in European Parliament, definitely at least for the time, until there is sanction list on the China side where MEPs, Miriam Lexman was supposed to discuss with us, and she's on that list. So how can we do business with China if they are putting our MEPs on list? And this comprehensive agreement was negotiated like for 10 years, and I'm definitely sure that it doesn't reflect matters like this, and therefore I am in the process with Roger to bring this topic to the platform of IPEC, Interparliamentary Alliance on China, which groups MPs from the whole world on issue of China. So this is something where it also will resonate soon, and maybe it will help to move something forward.
Wonderful, thank you. That was a very good answer. We actually have loads of questions coming in now, and some for Martin Hála, some for Roger, but I think I'm going to ask this question for Roger first. The questioner asks, would you say that based on your findings of the Frankfurt Stock Exchange report, the problems are substantially the same in Europe as they are in the US? Are the same types of bad actor companies in both places, or has Europe applied different standards?
Basically, it is the same pattern. As most folks will know, the US capital markets play a rather unusual role. The depth and volume and size, if you will, of the US capital markets are roughly the size of the rest of the world's combined. The US may possess roughly 66% of the world's investable capital or liquidity. It has the dollar, the world's reserve currency, and it puts it in an unusual category for China because it's very hard for them, with their voracious appetite for annual dollar financing, which is a rigid requirement that I would argue can only be satisfied by tapping in to the depth and volume of the US capital markets as well. You're not going to get there by going to London, Frankfurt, Hong Kong, Singapore, or elsewhere. Basically what you have here is the index funds and the indices themselves. MSCI Emerging Market Index, it's All Country World ex-US Index. The same is true with the FTSE Emerging Market Index and others. All of these index providers perhaps naturally want weighting or representation by China. In fact, China dominates the emerging markets, so it's seen as logical to have them in the portfolio in a big way. The problem is the diligence. The problem is, are these benign commercial companies, or are these companies that have a track record of wrongdoing? Are they sanctioned in the past? Are they engaged with, again, the Chinese military or human rights abuses? These kind of questions, frankly, weren't asked adequately, putting it generously. And so the fact is that these are benchmarks that are used by the whole world. These are multi-trillion-dollar index funds, make no mistake. So when you look at Frankfurt and probably Milan and London after that, you're going to see the same indexes. And we know instantly which companies are in the corporate bad actor business or are sanctioned, or both, immediately as to what's in those indexes. This is something we monitor. So leave it to say that they are built, if you will, in the United States. They're brought over to Europe as investment vehicles, not surprisingly, in this globalized world of ours, particularly in finance. And that's where the problem is. So that's why there's a commonality here on the transatlantic side that we need to be aware of. And I think that President Biden, I don't know whether he raised this issue in the G7, but it was fairly recently after his June 3rd announcement of this new executive order, so it's possible. But all I know is that we've got more to do than just the cautionary notes that were brought forward by the American president to his counterparts. We have a bigger problem here. It's concrete, and it's called money, and it's big money, and it's the biggest money in the world, to be precise. And it's underwriting that seemingly limitless checking account that China walks around with. I mean, how do we think they dominate Africa? How do we think that they're taking control of regions or are in the nation capture business to the extent that they are? Why do they seem to have this limitless financial capability? You know, it's curious until you look at the dimensions of what they're pulling out of the US cap markets, and you start to see hundreds of billions of dollars. Well, I'm not going to say that you know, we're funding all malign activities of China in the world by any stretch, but at the same time, what percentage is it? It's not small. And that's the kind of thing that all of us need to get our arms around sooner than later.
Yeah, I mean, as you so rightly said, it's quite shocking that this has not already blown up 10 years ago as an issue, that it has been allowed to continue basically without any oversight. There's no one talking about this issue. It is quite shocking. And we're very happy that there is now gaining attention on it, both politically and academically. So I have a question here to Dr. Hála. Based on your recent article on the Chinese disinformation campaigns against Czech Senate speakers, do you believe China would likely use a similar approach against politicians expressing support for capital market sanctions? Do you have any thoughts on how this could be countered?
Thanks. That's a great question. It's a little broad. I think the same tactics has been used and will be used selectively against people who somehow fall out of favor with Beijing authorities. it also depends, very much depends on how much focus these personalities might attract, how much attention they might attract from debating leadership. But if if this becomes something of concern, on the other side, of course, similar tactics like the one that I described in that, I think it was in the Jamestown China brief, that article. The same tactics or similar tactics will and have been used against other people. There's a, speaking of this, there's a whole range of tactical approaches that the Communist Party has developed over the years, how to deal with these situations, both in terms of advancing its united front linkages abroad, and also using its rather formidable propaganda and disinformation machinery. So they do have the means, and I have no doubt that they would use them. Thanks.
Wonderful. Thank you so much for your answer. So I have another question coming in from Zoom. And for anyone who's watching on Facebook, we can still take some questions from Facebook as well. So this question comes from someone from Zoom's, and they're asking about if the EU also considers China to be a systemic rival. And on the regulation side, it would be much easier to punch for such measures from the inside if it could be regulated from having bad actors in our stock exchange on the financial risks beside the security risk. So basically, I think what this person is trying to ask is, what are the financial risks besides security risks? So Roger, I think you touched on this briefly in your opening statements, but what actually are the financial risks of having these Chinese bad actors for Europe and for the US?
Well, I think they're very pronounced. In fact, I would call the risk asymmetric, particularly when you're dealing with human rights and national security violations, because if a company you're holding in portfolio is announced like the 5 companies today under US sanctions for forced labor violations, guess what's going to happen to the stock? And guess what's going to happen to your money in that stock, right? I mean, that's called straight up investor risk. Would you have been given a heads up that that company was perhaps a past human rights abuser? Were you told prior to buying the stock that they were involved in Xinjiang in polysilicon production, for example? Were you aware that they were building and militarizing islands in the South China Sea? All of this is knowable. All of this is open source, and yet, interestingly, you don't see it in the prospectus. You don't see it in the Securities and Exchange Commission filings in our country. I don't think you see it in the regulatory filings in Europe. In other words, where's the investor supposed to get this information? Are we supposed to leave it to the average European to have to do this research themselves? Heck no. I mean, this is the job of fiduciaries. And not to do it, there's a word for that. It's called fiduciary malfeasance. And frankly, I think that we're rife with that in the United States. So regrettably, I'd have to say that you're caught up in some of that as well. I mean, let's talk market for just a moment here. We can talk human rights and national security, but let's talk about the regulatory angle, as your questioner asked us about here. What do the markets care about? Well, presumably they care about disclosure, transparency, good corporate governance, a rule of law, risk management, preserving share value, preserving reputation and brand. Now that's market speak. I mean, as a Wall Street guy, I can tell you that. And so even on that basis, where is the adequate disclosure of material risks? Where do the Chinese volunteer that they're engaged in controversial activities like militarizing islands in the South China Sea illegally? Do you think that they come forward with that and say, by the way, I think you should know this about us? No chance. Do you think that the companies that are bringing them to market, the Goldmans and Morgan Stanleys and others, are enthusiastic about talking to you about prospective national security and human rights risks? I suggest to you no. Remember, there's money changing hands here. These are big time fees. We've got we're in a conflicted environment in terms of the well-being of US investors and European investors vis-a-vis those that are profiting on the market side. So I think the question is really on to something. It's easier, frankly, to fix a regulatory problem like this sometimes if you subordinate or not ignore, but you don't necessarily focus on just the politics and the subject matter of this type, no matter how compelling, if you can help solve the problem by simply saying, as Jan pointed out earlier, where's the rules-based game? Why is China receiving preferential treatment in America's cap markets over American corporations that have to obey Sarbanes-Oxley and other US federal securities law, where China was given a waiver in May of 2013 with an MOU signed by the United States that says, well, you don't have to worry about those pesky regulations or audits. We'll work that out someday. Well, here we are 8 years later and nothing's been worked out, except hundreds of billions of more have been taken out of the US with these high risk companies. So I do think you can get to it, in short, from a regulatory approach, basically by just enforcing current rules and laws and regulatory standards that every European company has to abide by. Why? And this is a fact in the United States, as unbelievable as it sounds. Why do they get a free pass? Why are they receiving preferential treatment? Now, is that really that hard to fix? I would say no, but it's not going to be fixed when you have fees and money dominating the proceedings here. So that's why this educational effort, in my view, is so vital.
Oh, well, thank you. That's a very clear answer, and I hope that answered the question from our audience. I just want to ask the audience, I'm going to launch a poll, so it's just a little bit of audience feedback. So as we get to the last couple of questions, if you just want to answer that, you can answer it through Zoom. And I think we have time for 1 or 2 more questions. We'll get to that right now. So I have one question coming in that's asking about the actual regulation that Europe can put in place. And the question is, how can Europe overcome the fact that most of its largest capital markets are in countries that are relatively favorable towards businesses with China? So countries like Germany and France. So would it make sense for smaller countries like the Czech Republic or Estonia to implement capital market sanctions, even if their impact was mostly symbolic? And that's a question for the whole panel.
Maybe I'll begin. I don't think that measure on the level of the Czech Republic or Estonia would really change something. It might be more symbolic, or let's say some kind of kickoff of a debate. However, my argumentation is that we should lobby in Brussels for this topic quite heavily and try to use the procedures we have in the EU as an organization. And to have this debate on a national level also means that at some point it should become a part of our foreign policy, and therefore interest of Prime Minister and other state actors to raise this issue in Brussels on European Council. So that might also change something. So let's have this debate. I wouldn't focus much on national rules more than necessary, since Czech capital market, it's really not something significant, and I don't think that we have any of those companies even here. So even if we do that, we don't have list them here. So since there's a free flow of capital in EU, it really makes sense to do it through Brussels. That's my reading. Maybe I'm wrong, but that's the way how I read it. That's the reason why I want to do it on level of IPAC, and then that's the reason why I think this should be brought to European Parliament.
Martin, any thoughts on that?
To the European Parliament.
Yeah, I would maybe just add that I think it's in exactly these countries' best interest, in the interest of those countries who are big traders, big exporters to China, like Germany, that China actually behaves by the internationally recognized rules. It's their business, and it's significant business that might be threatened by all sorts of predatory practices. So I think we need some educational work and need to patiently explain to our friends in places like Germany that short-term benefits and long-term interests might not always match, and that they might actually be in the long term undermining their own position by only taking into account short-term benefits. Thanks.
And my take on it, Simone, would be that acknowledging that we're operating in a conflicted environment. Germany wants to sell those cars, and France wants to sell those Airbuses. And these are not small matters. And let's face it, growth, exports, jobs are desirable things. And it's a logical thing to focus on. But not at the expense of our common security, not at the expense of our fundamental values, our principles, our values, our moral compass, and not at the expense of investor protection and those scores of millions of Europeans out there whose money it is that is funding a number of these egregious abuses, again, unwittingly. So I'm sympathetic with the idea that we want to, again, try to maximize economic benefit, but for goodness sake, we have to differentiate between the benign and commercial and the strategic and uniquely harmful. And so that's where we're falling down on the job. And I think that it is fully explainable to be able to take a stand. And I think the Biden administration has, and I think the Trump administration did before them, to be frank. You have two presidents there that are on the arguably opposite sides of the political spectrum, but they both called this a national emergency in the United States. They both use the International Emergency Economic Powers Act to make this happen, which is the most ferocious, if you will, the most comprehensive authority that the president has. So they're taking it seriously in the US now, and the Congress is certainly geared up on this too. So frankly, I think that it's time to share this experience with Europe and to see where we can, in a sound and prudent way, find that differentiating point, that walk that line between still enjoying commercial benefits of jobs and growth and exports, but at the same time, for goodness sake, you can't sacrifice what makes us free societies in the intervening period. That's all.
Wow. Well, I think that was an amazingly complete answer. And I think that basically rounds up our time perfectly. So I think that all that's left is for me to say thank you to all the guests who took time out of their day to participate, and to our amazing panel. You guys provided so much information, so much new information, and such complete answers. I'm sure we could sit here for another 3 hours and answer questions, but I know everyone has things to do, and places to be. And finally, I would of course like to thank the US Embassy who helped us support us put on this event. So thank you everyone. And if you haven't answered the questions in the poll, if you could do that now. Thank you so much.
Thank you. Goodbye.
Thank you. Bye.
Thank you. It was a pleasure. Thanks. Bye-bye.
I think we should shut it all off. If you can do it now.
Mhm.